There are crypto investors out there who made solid gains this year and are still paying way less tax than most people would expect. Not because they're hiding anything necessarily, not because they moved to some tax haven, and not because they found some shady loophole. They're just using 3 legal strategies that a surprising number of crypto investors still don't know about. And honestly, that's the part that's wild, because year after year, the investors who pay the least in taxes usually are not the ones who made the least amount of money. They're the ones who understand the rules. So in this video, I'm going to show you 3 ways crypto investors are quietly beating taxes right now. Each one is completely legal. Each one is already being used by sophisticated investors. And by the end of this video, you'll understand exactly why some people are paying a fraction of what you'd expect on the same size gains. And real quick, for context, we've been helping investors handle crypto taxes since 2017. And one of the biggest patterns we see is this. The people who save the most on taxes usually are not the luckiest. They're just the most intentional. And let's start with number one. Number one, tax loss harvesting in crypto and where the line actually is. So this is the part that gets people's attention and also where you need to be the most careful. In traditional markets, the IRS wash sale rule prevents you from claiming a loss if you sell an asset and buy it back within 30 days. But crypto is currently treated differently. As of today, the wash sale rule under IRC 1091 applies to stocks and securities, not digital assets, which the IRS classifies as property. That means many investors are able to realize a loss on a crypto position and still re-enter that position without automatically triggering a wash sale disallowance. So in practice, it can look like this. You realize your gains earlier in this year, maybe from a Bitcoin sale, Solana, or DeFi activity. Elsewhere in your portfolio, you're holding an unrealized loss, say in Ethereum or another token. You can choose to sell that position, realize a loss, and use it to offset your gains. That part is straightforward. Where things get nuanced is what happens next. While there's no explicit wash sale rule for crypto today, the IRS can still apply broader doctrines, like the economic substance doctrine, which requires that a transaction meaningfully changes your economic position and isn't done solely for tax purposes. In other words, selling and immediately buying back the exact same asset with no real market exposure or risk in between may be more vulnerable if scrutinized. On the other hand, transactions that reflect real portfolio decisions, such as wading through market movement, reallocating capital, or managing volatility, tend to carry much stronger support. So the takeaway isn't there are no rules, it's that the rules are less defined. And that puts more weight on intent, timing, and how the transaction actually behaves economically. That's why sophisticated investors don't treat this as a last-minute, end-of-year move. They monitor unrealized losses throughout the year and act when there's both a tax benefit and a legitimate portfolio reason to make the trade. Because done thoughtfully, tax loss harvesting can reduce taxable gains by a lot. But done mechanically, just to manufacture losses, it can create risk instead of savings. And that distinction is what most people miss. Number two, choosing which coins you're actually selling. So this one's massively underrated. For active investors, it can be one of the highest leverage tax decisions they make. Because when you sell crypto, the IRS doesn't just want to know that you sold, they want to know which units you sold. Did you sell the Bitcoin you bought years ago at a very low price? Or did you sell the Bitcoin you bought much more recently at a much higher price? Those are 2 completely different tax outcomes. But most investors never think about this because a lot of platforms default to FIFO, which stands for first in, first out. This means they assume the first coins you bought are the first coins that you sold. And if you've been in crypto for a while, those older coins are often your cheapest coins, which means FIFO can create the largest possible taxable gain, and that is the default a lot of people are getting stuck with. Now compare this to HIFO, highest in, first out. That means you're selling the most expensive units first. And if you sell your highest cost lots first, your recognized gain is often much smaller. Same sale, same portfolio, completely different tax result. Let me make that tangible. Say you're selling 10 ETH. Under FIFO, the system might assume you sold the 10 ETH you bought years ago at a very low cost basis. That could create a huge gain. But under HIFO, it might instead use the 10 ETH you bought much more recently at a much higher price. Now your taxable gain is way lower. Again, same exact sale, different accounting method, different tax bill. And then there's the most precise version of this, which is specific identification. That means you're choosing the exact lots being sold. That can be incredibly powerful, but it also means you need clean records. Because if your activity is spread across multiple exchanges, wallets, DeFi protocols, and NFTs, this gets messy fast. And this is where a lot of investors quietly lose money. Not because they made a bad trade necessarily, necessarily, but because they let the default accounting method decide their taxes for them. That's also why serious investors usually don't rely on whatever one exchange happens to show them. They use software that lets them track everything in one place and choose the accounting method intentionally. That's where a tool like Token Tax comes in naturally, because this isn't about really filing forms, it's about controlling the inputs that determine what you owe in the first place. And most people don't realize they even have this choice. Now, the first two strategies are about reducing the tax hit when you sell, but the third strategy is different, because this one is about potentially paying zero federal tax on gains legally. Number 3, the 0% capital gains bracket most crypto investors don't even realize they can use. This one surprises people every year because the US tax code includes a 0% federal long-term capital gains rate for people under certain taxable income thresholds. And a lot of crypto investors either don't know that exists or assume it can never apply to them, but it absolutely can. Here's the key. This only applies to long-term capital gains, which means you held the asset for more than 1 year before selling. That matters because the difference between short-term and long-term tax treatment is huge. If you sell before that 1 year mark, your gains are generally taxed at ordinary income rates. That can be much higher. But once you cross that 1 year threshold, you move into the long-term capital gains system. And depending on your income, that rate could be 0%, 15%, or 20%. Now, here's where sophisticated investors think differently. They don't just ask, should I sell? They ask, when should I sell? Because if you have a lower income year, maybe you're between jobs, maybe your income fluctuates, maybe you're taking time off, maybe you have a business with variable earnings, that might be the perfect year to realize long-term gains. And in some cases, those gains can fall into the 0% federal capital gains bracket. That's not a loophole, that's not aggressive, that's just understanding how timing works. And even beyond the 0% bracket, just waiting to cross the 1 year mark can make a huge difference. And the exact same gain can be taxed one way at 11 months and a very different way at 13 months. That's enormous. So this strategy is really about two things. First, holding on long enough to qualify for long-term treatment. And second, being intentional about which tax year you realize those gains in. That is where the planning beats reacting. And it's one of the clearest examples of how two investors can make similar gains but end up with a very different tax bill. Because one of them sold whenever they felt like it, and the other one sold with a strategy. Once you understand how investors are legally reducing what they owe, the next thing you need to know is how people accidentally get themselves flagged by the IRS. The IRS has been paying much closer attention to crypto, and there are very specific mistakes that can create serious problems for investors down the road. So we made a video on that, watch it right here. I break down the exact behaviors that can get crypto investors into trouble, including a few that catch people completely off guard. If you're taking your crypto taxes seriously, that's the next video you should watch. I'll see you there.